Whether money is shell or rock or gold or paper, it has three primary functions in any economy: as a medium of exchange, as a unit of account, and as a store of value. Of three functions, its function as a medium of exchange is what distinguishes money from other assets such as stock, bonds, and houses. Hello friends, welcome to my YouTube channel Safa's World. Our today's topic is functions of money. The first point we will talk about is the medium of exchange. In almost all market transactions in our economy, money in the form of currency or check is a medium of exchange. It is used to pay for goods and services. The use of money as a medium of exchange promotes economic efficiency by minimizing the time spent in exchanging goods and services. To see why, let's look at a barter economy, one without money in which goods and services are exchanged directly for other goods and services. Okay folks, let's take the case of Alan, the economics professor, who can do just one thing well: give brilliant economics lectures in a barter economy. If Ellen wants to eat, she must find a farmer who not only produces the food she likes but also wants to learn economics. As you might expect, this search will be difficult and time-consuming, and Ellen might spend more time looking for such economics-hungry farmer than she will teaching. It is even possible that she will have to quit lecturing and go into farming it herself. Even so, she may still starve to death. The time spent trying to exchange goods and services is called transaction cost. In a barter economy, transaction costs are high because people have to satisfy a double coincidence of wants. They have to find someone who has a good or services they want and who also wants the good or services they have to offer. Well, it seems very difficult. Let's see what happens if we introduce money into Ellen, the economic professor world. Ellen can teach anyone who is willing to pay money to hear her lectures. She can then go any farmer or the representative at the supermarket and buy the food she needs with the money she has been paid. The problem of the double coincidence of want is avoided, and Ellen saves a lot of time, which she might spend doing what she does best: teaching. As this example shows, money promotes economic efficiency by eliminating much of the time spent exchanging goods and services. It also promotes efficiency by allowing people to specialize in what they do best. Money is therefore essential in any economy. It is a lubricant that allows the economy to run more smoothly by lowering transaction cost, thereby encouraging specialization and the division of labor. The need of money is also so strong that most every society, beyond the most primitive investment, for a commodity to function effectively as money, it has to meet several criteria. It must be easily standardized, making it simple to ascertain its value. It must be widely accepted. Yes, money is widely accepted. It must be divisible so that it's easy to make change. It must be easy to carry, and it must not deteriorate quickly. Forms of money that have satisfied these criteria have taken many unusual forms throughout human history, ranging from wampum strings of beads used by Native Americans to tobacco and whiskey used by the early American colonists. Used to prisoner of war camps during World War II, the diversity of forms of money that have been developed over the years is as much as testament to the investment of the human race as the development of tools and languages. Come on folks, let's talk about the unit of account. The second role of money is provided a unit of account that is used to measure value in the economy. We measure the value of goods and services in terms of money, just as we measure weight in terms of pound or distance in terms of miles. To see why this function is important, let's look again at a barter economy where money does not perform this function. If the economy has only three goals, say peaches, economics, lecture and movies, then need to know only 3 prices to tell us how exchange one for another. The price of peaches in terms of economic lecture, that is how many economic lectures you have to pay for a peach. The price of peach in terms of movie and the price of economic lecture in terms of movie if there were 10 goods. For example, we would need to know 45 prices in order to exchange one good for another. With 100 goods, we would need 4,950 prices, and with 1,000 goods, 4,99500 will be the price. Imagine how hard it would be in a barter economy to shop at a supermarket with 1,000 different items on its shelves, having to decide whether chicken or fish is to barter by if the price of a pound of chicken were quoted as 4 pounds of butter and the price of the pound of fish as 8 pounds of tomatoes. To make it possible to compare prices, the tag on each item would have to list up to 999 different prices, and the time spent reading them would result in very high transaction cost. The solution to the problem is to introduce money into the economy and have all the prices quoted in terms of units of that money, enabling us to quote the price of economic lectures, speeches, and movies in terms of, say, dollars if there were only 3 goods in the economy. This would not be great advantage over the barter system because we would still need 3 prices to conduct transactions. But for 10 goods, we need only 10 prices. For 100 goods, 100 prices, and so on and off. The 1,000 goods supermarket, there are now only 1,000 prices to look at. We can say that using money as a unit of account reduces transaction cost and economy by reducing the number of prices that need to be considered. The butterflies of the function of money grows as the economy becomes more complex. Now, last but not the least, let's talk about the store of value. What is a store of value? Money also functions as a store of value. It is a repository of purchasing power of time. A store of value is used to save purchasing power from the time income is received until the time is spent. This function of money is useful because most of us do not want to spend our income immediately upon receiving it, but rather prefer to wait until we have the time or desire to shop. Money is not unique as a store of value, and any assets, whether money, stocks, bond, land, houses, art, or jewelry, can be used to store wealth. Many such assets have advantages over money as a store of value. They often pay the owner a higher interest rate than money, experiences price appreciation, and deliver services such as providing a roof over one's head. If these assets are more describable store of value than money, why do people hold money at all? The answer to this question related to the important economic concept of liquidity. The relative ease and span with which an assets can be converted into a medium of exchange. Liquidity is highly desirable money in the most liquid assets of all because it is the medium of exchange. It does not have to be converted into anything else in order to make purchases. Other assets involve transactions costs when they are converted into money. When you sell your house, for example, you have to pay a brokerage commission, usually 5% to 7% of the sale price. And if you need cash immediately to pay some pressing bill, you might have to sell for a lower price in order to sell the house quickly because money is the most liquid asset. People are willing to hold it even if it is not the most attractive store of value. How good a store of value money is depends on the price level because its value is fixed in terms of price level. A doubling all the price, for example, means that the value of money has dropped by half. Conversely, a halving of all price means that the value of money has doubled. During inflation, when the price level is increasing rapidly, the value of money has doubled. Money loses its value rapidly, and people will be more reluctant to hold their wealth in this form. This is especially true during period of extreme inflation known by hyperinflation, in which the inflation rate exceeds 50% per month. Hyperinflation occurred after World War I with inflation rates sometime exceed 1000% per month. Wow! By the end of the hyperinflation in 1923, the price level had risen to more than 30 billion times what it had been just 2 years before. The quantity of money needed to purchase even the most basic items become expensive. There are stories, for example, that near the end of the hyperinflation, a wheelbarrow of cash would be required to pay for a loaf of bread. Money was losing its value so rapidly that workers were paid and given time off several times during the day to spend their wages before their money became worthless. No one hold on their money, and so the use of money to carry out transaction declined and barter became more and more dominant. Transaction costs skyrocketed, and as we would expect, output the economy fell sharply. Hope you like this video. Please like and subscribe Istafa's World. Thanks for watching.